Chapter 14, The Roaring Twenties, Part 5, The Great Stock Market Crash. Suddenly, without any apparent warning, the fun in urban America stopped abruptly towards the end of October 1929 when the great Wall Street stock market came crashing down, and with it the fortunes of thousands of Americans. Overnight, the boisterous optimism of industrial America turned into fear, and then sad resignation as the national economy at the beginning of the 1930s collapsed into a long and deep depression. American consumers and market saturation. During the 1920s, businesses that had made radios, vacuum sweepers, washing machines, cars, etc., reaped huge fortunes from the sale of these goods to eager American buyers or consumers who wanted to have the latest new thing that came onto the market. Such ownership signified arrival at the good life. So the market for such goods was hot, driven by consumer desires to own all these new things. And so consumers bought these things in droves. And thus the businesses that made them were busy. And workers had jobs. Companies were making great profits. Investors were getting fine dividends on their investments in these companies. And everyone was happy. In the capitalist system, the profits made by these companies, the profits anyway that were not plowed back into production expansion of the companies, were distributed as dividends to the owners of the company in accordance with the numbers of stocks or shares of the company that an investor owned. You bought these stocks or shares on the open stock market, Wall Street stock market being a favorite. Anyone with money could buy a share or two or 20 or 100 or maybe many hundreds, depending on how much money you had to invest in these stocks. Speculative fever. Throughout the 1920s, stock markets were busy buying and trading shares as people everywhere wanted to get in on the profits. People started frantically bidding higher and higher prices for each of those stocks or shares, not for the size of the dividends they would receive as shareholders, which in terms of what they now had to pay for a share was minuscule, but because they figured they could turn around in short order and sell these shares on the stock exchange or stock market to someone else for far more than they had paid for them, pocketing a huge profit in the exchange. This was called speculation. Towards the end of the 1920s, speculation fever was running hot. People cashed in their life savings to get into the stock market. They even borrowed huge amounts from banks on margin, that is, just putting up themselves personally a small percentage of the money needed to buy these stocks and borrowing the rest of the needed money from banks, so that these mom and pop investors found themselves deeply in debt. But they all figured, what the heck, I can turn around and sell these stocks in a few months for much more than I paid for them. I can pay back the bank and pocket the huge amount still remaining. That was a marvelous idea, as long as the speculative fever continued to drive stock prices up at this continuing frenetic rate. Dark clouds. But towards the end of the 1920s, the economic picture in American industry was beginning to change. People were still buying radios, home appliances, cars, though not at the same rate as in the early and mid-1920s, because most of the people in a position to buy these things, that is, the urban middle class, possessed most of these things by the late 1920s. There were fewer new purchases of these goods coming into the economic marketplace. As a result, sales slowed down, profits declined, production slowed, and workers were let go in small numbers. And the bloom on the economic picture faded a bit. the crash itself. The smart money boys decided it was time to sell their stocks. Moms and pops were still rushing to get into the market, but the big money boys were becoming cautious. Then other investors started to take notice of what the smart money was doing and began to step back. Quickly, rumors of the step back began to spread, and uneasiness set in as people became less confident that the easy money was going to continue. Concern resulted, especially because many people were heavily indebted to the banks, and a slowing stock market could mean trouble for them. As people started to sell stocks, they were willing to do so at a lower price just to get out. Soon prices started to drop rather seriously. By the end of October 1929, they were dropping precipitously. Suddenly, people who just a month or two before were incredibly rich now found themselves in such massive debt that they were not now just poor, they were totally bankrupt. Footnote. Actually, the stock market decline would continue all the way downward into the early 1930s. The Dow Jones Industrial Average reached its highest level in early September of 1929 at a little over 380 points. But by late October, it had dropped to 230 points, having dropped nearly 70 points on just the 28th and 29th of October. By mid-November, it dropped below 200 points, and then began a slow rally, reaching a secondary peak of nearly 300 points in mid-April of 1930. Then it began another slide the next year, 1931, reaching its all-time low of a little over 40 points in July of 1932. It would not recover its 1929 high until 1954. The sobering effect of the crash. What a tragic end to a decade that started out with such material promise, at least in the cities. But such tragedy would have a wonderfully disciplining effect on Americans as they faced a new decade, the 1930s, which required of them morally and spiritually much greater effort than they had employed during the Roaring '20s. It is just as well, because Americans were going to have to be much leaner and hungrier than they were in the 1920s in order to face successfully the challenges to their civilization that events of the 30s, the Great Depression, and first half of the 40s, World War II, would throw in front of them.